Hi everyone, my name is Benjamin Christian. I will be briefly taking you on accounting. The topic is trading profits and loss account. Now, before we look at the topic, let's look at the meaning of accounting. Accounting is all about it can be defined as a classifying, summarizing, and analyzing a financial statement to enable users to give or financial decision making. It's all about enabling the accountant to make what financial decision making. As a company, every company needs what an accounting information, financial information to enable them make decision that has to do with your finance. Before ever a company can invest, they must look at the financial statement, whether it will invest or not. That's what account is all about. Okay, now let's look at the meaning of trading. What's an account? Trading account is an account prepared to ascertain the person the company is making is to ascertain the person company was gross profit or loss. So he said the trading account is prepared to ascertain the company was gross profit or loss. Then we have what we call profit and loss account. Is prepared to ascertain the company was net profit or loss. So we have categories of two accounts. We have trading account. We have what we call profit and loss account. So the trading account is prepared to ascertain the company gross profit or loss. Then we have what we call the profit and loss account is prepared to ascertain the company was net profit or loss. So let's look at the meaning of gross profit. Gross profit. Gross profit. Gross profit. Gross profit can be defined as excess of selling price over cost price. As the excess of selling price over cost price. You bought a bag of rice 10,000, you sold it 15,000 naira. You bought a bag of rice 10,000 naira, 10,000 naira. You sold it 10,000 naira. You sold it what 15,000 naira. So this is a cost price. Why this is what a selling what price? A selling price. The selling price. Okay, so let's go. So this minus this, you have what's called five. You have to call what 5,000. So this is your cost price. Why this is your selling price? So if you minus these two, you have what's called 5,000. 5,000 is called your what gross profit. It's called what gross profit. It's called gross profit. Then we have what to call what either gross profit or what or gross what or gross loss or gross loss. When the cost price exceeds the selling price, it becomes a loss. It becomes a loss. I said that gross profit can be defined as the excess of selling price over cost price. The excess of selling price over cost price. So if you bought an item and if you sold it above that cost price, it's called what? It's a gross profit. Okay, but if you sell it below the cost price, because what problem? Because a problem. Now the essence of every business is to maximize profit. This is why ABC go to business. This is why you and me want to embark a new business. It's to maximize what profit, maximize profit, maximize profit. So at the end of the day, if you're not maximizing profit, then something is wrong. Something is wrong. Is wrong. So here's the gross profit can be defined as the excess of selling price over cost price. Then we have to call gross loss. Gross loss simply means what the excess of cost price over selling price. So if you bought the bag of rice 10,000, you sold it 15,000 naira. If you balance these two, what you have is called 500, 5,000. This is called what? Your gross profit. So, but if the cost price is 15,000 naira, for instance, then the selling price becomes what 10,000 naira because it was a problem. That means that it is what gross loss. It is gross loss. But the cost price is bigger than the what selling price. It's gross loss. So that take us to another page. Then we have what we call the net profit or net loss, net profit or net profit or net what loss, net profit or net loss. Net profit is the total expenses minus from your gross profit. Total expenses minus from your gross profit is called what? Net profit. Total expenses minus from your gross profit is called what? Your is called what? Called net profit. Then net loss simply means when the total expenses exceed your gross profit, then it's called what? Net loss. When the total expenses exceed your gross profit, it's called what? Net loss. Okay, now let's take a statement. Let's take a statement. Then let's see how it goes. Let's see. As if for example, in example one, we can say example one. Example one. example 1. Okay, we can say that the following, can say the following are, are financial statements, of blessing, enterprise, blessing enterprise, as as at as at 31st 31st September 2025. Or let's 31st of, let me say 30th of August 2025. So we have what we call number one, we have what we call opening stock. Let me say opening what? Inventory. Opening inventory. Giving us what? 10,000. We have what we call purchase purchase of inventory. Purchase of inventory. Okay, let me say purchase of opening inventory. Or let me say, okay, let's just say add what? Let's say purchase. Purchase giving us what? 5,000. Then we have uh let's say our sales is giving us as what? As a 60 what? As 60,000, as 50,000 naira our sales. Then we have closing stock, closing inventory. Closing inventory is giving us is giving us um is giving us 8,000 naira. Then we have what we call rent, salary and wages. Salaries, and wages is giving us salary and wages is giving us 1,000. Okay. Then we have, all right, we have what we call transportation. Transportation. Transportation is giving us 2,000 naira. Then we have what we call general expenses. General expenses. General expenses. General expenses. General expenses is giving us 3,000 naira. It's giving us 3,000 naira. It's giving us 3,000 naira. Okay? So we can say at this junction, then we have what we call what? Carriage inward. It's giving us 4,000 naira. Then carriage outward. Carriage outward is giving us uh, 1,500. Then number 9, we have return inward. It's giving us 2,500. Then we have return outward. It's giving us 3,300. allowed is giving us 4,100. Then we have discounts. We have receive. Discount receive is giving us 5,000 naira. Discount receive is giving us 5,000 naira. Okay, so this one can say you are required to prepare trading trading profits and loss accounts as at 30th of August 2025. So look at it now. He said that this is an example. He said the following are financial statement of Blessing Enterprise as at 30th of August 2025. He said that opening inventory. The opening inventory can also be seen as what stock. The amount of money start to what a business called the opening inventory. Then we have purchase. Purchase simply means that you added extra goods to the business. The extra goods to the business. The initial process of the business was more than this. But at that moment, you started business with this. Later, you added extra goods to the business. Then we have sales. Sales. The amount of goods you have sold at a particular time. The amount of sales you make. That's called sales. Sales giving us this. Then we have closing inventory. At the end of the month, the stock that is still remaining, it's obvious that you may not sell all the goods at that same time. But the good that is still remains called what the closing inventory. Not that what stock still means what inventory. The word stock and inventory still means what the same. Then we have what got salary and wages. In course of running your business, you pay what wages and you pay what salary. You pay your workers. These are expenses incurred in course of running your business. Then we have called transportation. Yeah, it's also incurred in running or one of the expenses incurred running your business. Then we have what called carriage what inward. Carriage inward is also additional what expenses incurred. The amount of money you spend to carry the goods from where you go to your store is called what carriage inward. Then we have carriage what outward. The amount more like delivery. This carriage inward is the amount of money you spend. For example, you went to the market to buy two things. From where you are staying to where you are, the market is very far. So the transportation you pay from where you bought your goods to your house is called what carriage what inward. It's added as a cost of expenses incurred. Then we have what called what carriage inward. All these are also kind of more like delivery. They are all expenses incurred in running your business. So we have what discount receipt. For example now, so I bought marker. This marker is cost 200 naira, but because I'm a customer, the person gave me what 150. That 50 naira is the discount given to me. Alright, for prompt payment. In other words, the essence of discount receipt is to enable what prompt payment. Enable prompt payment. So discount receipt is given by the seller to the buyer to enable him to pay promptly. If the price of this marker is 200 and as a customer I'm giving I'm being what paid or I'm being asked to pay what 150, the extra is what the 50 is giving us a discount. Then we have what we call discount receipt. Discount receipt also is sorry, discount allowed is given by a seller to enable the buyer to pay what promptly. While the discount received is received. So one, this discount allowed is an expenses that affect the seller, while discount received is an income that affect the the buyer. So this is an income while this was an expenses. This is an income while this is an expenses. This affect the seller while this affect the buyer. Positively, this affect the seller negatively. Okay, now at this one we can say solution. Let's look at a rough work. Let's look at a rough work on this. Okay, can I say solution? And so solution. We say the name of the business is Blessing Enterprise. Blessing Blessing what? Enterprise. enterprise. We had trading profit and loss account as at 30th of August 2025. So this is how it is. This is how it is. Okay. So you can come here. Okay, let's start. So number one thing we have here is I'm trying to adjust the board. Number one, you can say that we have one, then we have one here. Okay, so we have our opening stock comes here. Opening stock comes here. What is the opening stock? Opening stock giving us what? As 10,000. Opening stock giving us 10,000. Okay, that is opening stock. We said that added the business or our initial plan to start the business was more than 10,000. But what we have at that moment to start the business was 10,000 naira. So we said add what? Add purchase. Add purchase. Purchase is giving us is giving us what you call 5,000. Okay, 5,000. We can say that okay, this plot is giving us 15,000 naira. So we said we added extra goods to it, 5,000. We say you can say what add what carriage, add carriage what inward, add carriage inward. Carriage inward is giving us as that is carriage inward. Carriage inward is giving us as okay, let's say this is this, 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 this is this. So our carriage inward, I think that these two are expenses, but one affect the cost of product, one affect the cost of goods purchase, one affect the cost of I want to produce buy these things. So I can't carry those goods from from the store or from where I bought it to my house. It's very far. So I have to pay a means. You understand? The transportation I paid to carry the goods from where I brought to my house is called the carriage word inward. So the carriage inward is giving us 4,000 word naira. 4,000 naira. So this is giving us. So if you say that 10,000 naira plus 5,000 naira plus this is giving us what 19,000 naira. So after God say what let's return outward. Let's return outward is giving us let's return outward is giving us what 3,300. Now let's return outward simply means that you find out that this worth of goods is damaged. When you buy something and you find out that the goods is damaged, you have to send it back to the seller. Now at this point we are buying, that where you are selling. Right? So out of the goods we bought goods of 10,000 naira, we bought extra goods again, 5,000 naira. Then this was our cost of transportation, for example. So cost of transportation, for example. So say this plus this plus the cost we cure to carry the goods from where I'm just giving an example. So I'm just giving an example. Say this plus this give us this 90,000 naira. And out of the goods that we bought, found out that 3,300 naira goods was damaged. 3,300 naira goods was damaged. So we have to return it back to the seller. It's not called return outward. So the seller is a return inward, while to the buyer is a return outward. So because we are buying here, we have to return these goods back to the seller. This 3,300 naira, we are returning it back to the seller because we bought it and we found out that out of what we bought, this what of goods is damaged. So we have to return it back to the seller. So this minus this now give us, if you say 19,000 naira, 19,000 naira minus 3,300 is giving us what? It's giving us 15,000 naira. It's giving us 15,000 naira. So this is called. So you can put this figure this side. Can put this. So after we gotten this one, let's say less for closing stock. Less for closing stock. Okay. We say less what closing inventory. closing inventory. The closing inventory is giving us, what is our closing inventory? Is giving us what? 8,000 naira. Okay. So now, first of all, you say that this plus this give us this. This minus this gave us this. This is our return actual. We are returning it back. So you got this one. And then we are so this is the total goods we have now. 15,000 naira is the total goods we have now. Because we are returning this to the sellers. So at the end of the day, we are still having this as what remaining goods. We are still having what 8,000 as remaining goods. We are still having 8,000 as remaining goods as our closing inventory. So you say that's what 15,000 naira. 15,000 naira minus 8,000 naira minus 8,000. So you say that we are, so now come say what you have now. Minus this, what you have is what 7,000 naira. It's called what? It's 7,000 naira. It's called what you have now is seven what? You have 7,000 naira. It's called cost of goods available for sale. For what? For sale. 7,000 naira. That's what we have. That's what we have. So if you look at our calculation, we say that this was our opening stock, purchase, opening stock was giving us this, purchase was giving us this, giving us this. Then add carriage inward, which is this. Carriage inward, which is give this. So this plus this plus this give us this. Alright? This plus this plus this give us this. So you say that what? Let's return outward. Let's return outward is giving us as this. As this. So we say this minus this give us this. Give us this. This is our total goods. Alright? Then we say that we want to know the actual cost of goods sold. So we say let's closing what inventory. At the end of the day, we are still having some goods that are remaining. And then we say you are still having some goods that are remaining. So you minus this good from this goods now. We find out that we have what we call cost of goods available for sale. That means that the actual goods that we are ready to sell. Cost of goods available for sale, the actual goods. Okay, so we have what we call, we come here after this, we have what we call our sales. Our sale. So sales is giving us what? It's giving us 50,000 naira. So sales is giving us 50,000 naira. Sales is giving 50,000 naira. We said that between return inward and return outward, one affect your sales. One affect your sales. If I went to the market to buy something and I bought it and I found out that some goods is damaged, I turn it back to the seller. It's a return for me. The buyer is a return outward, while the seller is a return inward. So return inward will come here to affect the seller. So you say, well, let's what? Let's return. Let's return. Let's return inward, giving us 2,500. Sorry, let's correct something here. Let's correct something here. Let's correct something here, please. Then this plus this give us this. All right. This minus this give us this. This is our cost of available for sale. This is our cost of available for sale. All right. This is our cost of available for sale. So this is our cost of goods available for sale. We have returned this thing. We have returned this thing. So this is our cost of goods available. There's no space available for sale. So why this? Let's correct this. Why this is what we call. So this give us this. This is our return outward. So this minus this give us this. So this is called cost of goods available. There's no space available for sale. Let's go. Cost of goods available for sale. Let's go. Opening stock 10,000. Purchase 5,000. Carriage inward 4,000. This plus this 9,000. 9,000. Then we have let's return outward giving us this. So this minus this give us what 15,000 naira. Known as what we call cost of goods available for sale. So the total goods that is available for sales is this. Then at the end of the month, we are still having some goods that are remaining. So if you minus the one that is remaining from goods that we see, this is the goods that we want to sell. This is goods that we want to sell. That's why I say available for sale. Then at the end of the month, these are the goods that are still remaining. That means that out of this we have sold, out of this we have sold. So if you minus this and that means that out of these goods, out of these goods, for us to know actual goods we have sold, for us to know the actual cost of goods we have sold, we have to minus the one remaining from this. This is total goods that we have. This was still remaining. So for us to know the actual goods we have sold, we say, well, this minus this, giving us, so that's what cost of what? Of goods sold. So this minus this now give us what we call, now what we call what? We call 7,000. This is what we call 7,000. This plus this plus this give us this. This one of this give us this. This one of this give us what? This is called cost of goods sold. That means total goods we have sold. This is the total goods we want to sell. We haven't sold it, we want to sell it. Why? This is the total goods we have sold. We have sold it already. We have sold it already. For us to get our gross profit, so all what we are doing now, we are looking, look at what we are looking for. We are looking for this. Look at what you are looking for. All this what you are still looking for this trading account. At the end of the day, we must get our gross profit or loss. We must get gross profit or loss. At the end of the day, we must get gross profit or loss. So let's continue. We'll come and say your sales is giving us this. Then let's return inward. Let's return inward. So if you minus out of 50 naira, if you minus 2,500, you have what to call 50 naira. Let's go together. 50 naira minus 2,500. You have what to call 47,500. Now this is called turnover or net sale. What do I say? Turnover or net sale. So you can say your result turnover. This is turnover or net sale or what? Net sale. So say gross profit can be defined as the excess of selling price over cost price. As the excess of selling price over cost price. So this is the selling price, while this is the what? Cost price. This is the selling price, while this is the cost price. That's what we call it net sale. Call it what? Net sale or turnover. Change of sales, turnover. So for us to balance the account, we say what? We say what? Gross what? Gross profit. Gross profit carry what? Down. This figure, this minus this, this minus this minus what do you have? You say 47,500. Then you minus you minus this. So you minus this two, what you have is 47,000. 47,000 minus 7,000. What do you have? Say 47,500. That's minus what? Minus 7,000 naira. We have what's called 40,500. That was got 40,500. So come here. We have 40,000. So come here. We have 40,500. Why this figure come down here giving us 47,500. Come and say what? Gross what? Gross profit brought brought down. This figure will come up here giving us 47,500. Then we have this as giving us 40,500. Put your sign to show that we are done with what? Account. Wow. Is it that easy? Is it difficult? This account for you. Very, very simple. So we just end up all what we solve now, we just end up getting what? Trading account. End up getting what? Trading account. You see how to solve for what profit account. All right. Let's say very simple. Let's just preview it. We said that the opening stock is 10,000, purchase giving us 5,000. We have add carriage in was giving us 4,000. So this plus this is giving us 19,000 naira. We'll come and say, well, let's return outwards giving us this. This minus this give us our cost of goods. I've left for say the amount of goods. I've left for say amount of goods. I've left for say I've left for sales, giving us this. Then we have less closing inventory. Less closing what? Inventory is giving us this. So this minus this giving us this. Then we have what we call sales. This minus this giving us this. This minus this giving us this. So this is what we call turnover, or let's say turnover minus this. This minus this is giving us this. This is your gross profit. The excess of selling price over cost price. The excess of selling price over cost price. This is the selling price, while this is the cost price. Isn't that amazing? That means that when we have the profit of all, this is our profit. Gross profit carried down. Carry what? CD carried down. Gross profit carried down. CD carried down. Then we have gross profit brought down. So at the end of the day, this is our profit here. Profit is giving us this. All right. This is your cost price, while this is your selling price. So if minus this and this, you have your profit of this. Then this figure is come down to then this figure go up. Why? The profit is carried down, profit is up. While the profit is brought down, the profit is what is down. We put this sign to show that we are done with the account, and also help to eradicate the issue of what? Issue of fraud. All right. So let's look at the big aspect of it, which is what? Profit and loss account. Profit and loss account. Profit and loss account. So we have okay, we have this profit and loss account. Profit and loss account. Okay, let's continue from that where we stop. Okay, still continuation. We are through with trading account, so we want to look at the profit and loss account. Let's see how it goes. So we have still from where we stop. We have we are going to say that net profit simply means your addition of all the expenses minus from your gross profit. So you're going to add all the expenses minus it from our what? Our gross profits. Then whatever we get to come because of our what? Our net worth profit. Okay, this is the example of the expenses we have stated there in our question. I just stipulated only the question, only the statement, only the expenses. Then I think that this account have two segments: trading account for you to get your gross profit or loss. Then we have the P and L account for you to get your net profit or loss. For you to get your net profit or loss. That's the two accounts. So we are done with the trading account, and if you can see, we find out that we have gotten our gross profit. This is our gross profit. At the end of the account, we've gotten our gross profit, giving us this. All right. So we want to get our net profit or net loss, calculating for this. We'll come here and say, well, calculation for where we stop. That's it. We have expenses. Say expenses. The expenses we have there is we have transportation. We have transportation giving us um giving us 2,000 naira. Then we have salary and wages. Salary and wages giving us 1,000 naira. Then we have general general expenses giving us 3,000 naira. Then we have carriage, okay, carriage, carriage artwork giving us uh carriage artwork giving us 1,500. Then we have discounts. We have discount allowed. Discount allowed is giving us 1,000. Okay. So sorry, there is discount receipt here. So discount receipt is giving us here. I didn't write the figure out already. Remember, discount receipt is here. Discount receipt give us a figure. You have a discount receipt here. The discount receipt is added to our gross profit to give our total income and account. Normally, in the question, there is discount receipt in the question. Normally, there is discount receipt. We omitted it. So take note. Discount receipt is being added to your gross profit, which is this. It is added to your gross profit here. Then if you plus this your gross profit plus your discount receipt, it will give you a figure. It will give us a figure. That figure is known as called total income. Total income. So discount receipt is added here. to give us a figure, known as total income. Then, so if you plug this, these are the expenses. You plug this plus this plus this plus this plus this. Say, well, let's go to say 2,000 naira plus 1,000 plus 3,000 plus 1,500 plus 4,100. We are able to call total is giving us 11,600. So the total expenses, total what? Expenses is giving us 11, it's giving us what? 11,000, 11,600. That's 600. So for you to get to our net profit, we say that addition of all your expenses minus from your gross profit. If you observe now, our gross profit giving us 40,500, while our total expenses giving us 11,600. So if you minus these two, so you can say, you say what? You say what? So for you to get your net profit, say 40 what? 40,500 minus this, minus what? 11,600. What you have? Say what? Say 40,500. 40,500 minus 11,600. You're giving us what? 28,900. Give us 28,900. So this is your total, this is your net profit. We come here, we say what? To get our net, we say net what? Profit. Net profit is giving us what? It's giving us what is it? It's giving us 28,900. This is our net profit. This is our net profit. That's how we get to our net profit. Or you can see say like net profit is giving us carry down, it's giving us this thing. Why this one is giving us as what? As 40,500. As what? 40,500. As okay, as 40,500. Come here, see the same thing. So net profit is giving us, there's no space here. But I written it, there's no space here. So this is where we stop. That is giving us this thing. Giving us so if you plus, if you, this is your gross profit, this is your total what? Expenses. So this minus this is giving this. This is your net profit. This is our net profit. So our net profit is giving us this. Why? Because the gross profit bigger than what? Total expenses. If total expenses is bigger than the what? The gross profit, then we know that there is what? Issue. Bigger than the gross profit, then we know that there's what? There's an issue. There's an issue. This is our gross profit. Okay? This one. So that is it. Our net profit, there's no split. I'm writing that our net profit is giving us as what? As this. So that is it. So then let's look at two major areas. Let's look at some areas that requires explanations. Let's look at some areas that require explanation. Let's critically look at those two areas. Those two areas. Now, when you talk about trading account, we are looking at there are some key factors you are going to look at. Number one, we are looking at the cost of production, which is very important. Which is cost of goods available for sale. Sorry, we have the cost of what? Cost of goods available for what? For sale. This is very important. Then also look at the what? Cost of goods. Cost of goods sold. Then also look at the what? The gross what? Profit or loss. Also, we also look at what? The gross, we also look at what? The net what? Profit or loss. These are the critical area of trading account. These are, if you look at it now, look at the step, look at it now, look at the step. If you look at the step, we have step one, look at step one here. Cost of goods available for sales is this. Where is it? It is. Look at step two. Step two is cost of goods sold is this. Cost of goods sold is this. Yeah. Step three, gross profit or loss is this. Then we have what's called net profit is what is this. These are the basic or steps that you must put into consideration while you are working with it. Cost of goods is the actual goods that you bought to sell, you haven't sold it. Cost of goods are not for sale is the actual goods you bought to sell, you haven't sold it. Then cost of goods sold, at this point you have sold it. At this point you have sold your actual cost of goods you have sold, not your sale. Your actual cost of goods you have sold. So the difference between sale Now let's analyze between this word and sales. This is the cost price, while this is the selling price. That's what I explained to you. Cost price, selling price, and what? Cost price. Selling price and cost price. This is different between these two. This is different between these two. Cost price and what? Selling price. So cost of goods sold is what the real is the cost of the price, while it's the selling price. At this point, I think we'll stop here. I believe that we have done justice to it. Account is very simple. It's all depends on your interest. Account is as simple as ABC. Depend your interest. Put the right formulas and get it right. Thank you very much.